Hello and welcome to today's webinar. Thank you so much for joining. We're just verifying the audio and then we'll get started momentarily. Sounds like the audio is working. So today's a great session. We're going to let folks join in. We're going to be going over a deep dive presentation on the solo 401k contribution rules for 2020 as well as 2021. And it's specifically focused on individuals whose self-employed business is taxed as a sole proprietorship, a single member LLC, or a 1099 independent contractor. So I would ask you to please ask questions in the chat and I will answer those questions as we go through the slides. Please also like this video. We'd really appreciate it if you would like the video, and please subscribe to our channel so you get notifications of future webinars, our weekly webinars. We can start here in a moment. So here's a roadmap of what we're going to be going through. So we're going to go through the contribution limits. We're going to discuss some scenarios and examples, how to use our online calculator, the solo 401k contribution deadlines, how to make contributions, how to report contributions, and go through some common misconceptions as far as what is and what is not a contribution and therefore does or does not count towards the contribution limits. So the focus of the presentation, again, just to be clear, is sole proprietors, single member LLCs. If you report your income, your self-employment income on Schedule C, if you, for example, are a 1099 miscellaneous or under the new language 1099 NEC Independent Contractor. So the starting point in terms of making contributions is that you have to consider different factors that go into how much you can contribute. So number one, what's your self-employment income? That's always the starting point because you can never contribute more than you earn. So you have to have earned self-employment income as a basis to make a contribution and justify a contribution. Another factor is your age. You'll see as we go through the slides that if you're 50 or older, you will be able to contribute more than for someone who's under 50 years of age. Whether you participate in another retirement plan. For example, if you have a 401k plan through a day job and you make contributions to that plan, that's going to impact the contribution rules and limits with respect to your ability to contribute to a solo 401k. And then finally, the type of contribution. So you've got employee versus employer contributions. You're able to make both types of contributions because in the words of the IRS, you're both the employee as well as the employer. Pre-tax contributions, Roth contributions, and voluntary after-tax contributions are also different types that we will go through as we go through these scenarios. So in terms of the first factor, which is self-employment compensation or self-employment income. So if your business is taxed as a sole proprietorship, a single member LLC, or you are acting as an independent contractor and you get a 1099 miscellaneous or NEC, your ability to make contributions is going to be based on the net income that you report on Schedule C after reducing such net income by 1/2 of the self-employment tax. So you've got to do that pre-calculation and then you can figure out how much you can contribute as far as employee contributions, employer contributions, and down the line. So a couple of key factors to note is you don't want to consider W-2 wages from other sources like a day job. Don't consider investment income, such as income that's reported on Schedule E. Remember here, we're talking about Schedule C income. So as far as the calculation, you're going to start with net profit. So that's going to be, line 31 of Schedule C. You reduce it by 1/2 of the self-employment tax. So our solo 401k calculator does this for you. And you'll see as we go through the slides there. And I see that we've got a question that's come in. Thank you so much for asking that question. Please don't hesitate to ask more questions. We'll go through a few more slides and then we'll knock out a batch of questions. So the next consideration is going to be the contribution, the overall limit. So for 2020, the overall limit is $57,000. Your catch-up limit is $6,500 if you're 50 or older. So that's how you can get to $63,500 because the catch-up limit doesn't count towards the 57. Then you've got $58,000 for 2021. And the catch-up limit stays the same at $6,500. So you can get up to $64,500 if you're 50 or older. And you'll see with some examples how we get there. Then, as we mentioned before, you've got the different contribution types. You've got employee versus employer. So employee can be made as a pre-tax, a Roth, or even what they call a voluntary after-tax. Employer contributions are always going to be pre-tax contributions, and those contributions are not impacted by contributions made to a day job plan. Whereas employee contributions are impacted because the limit applies at the employee level. So you have to aggregate across all plans that you make contributions to as an employee. That's why one of the factors is asking whether or not you participate and make contributions to another 401k plan, like through a day job. You've got Roth contributions. To dig a little deeper on those always fall under the employee contribution category. And they do include, therefore, the catch-up contribution amount. So if you're 50 or older, that's how you could make a Roth contribution all the way up to $26,000. And then the voluntary after-tax, which is how you take advantage of the mega backdoor Roth. And I would encourage you to take a look at our mega backdoor Roth webinars. I'll include a link to in the comments after this video posts. And by the way, if you're watching this video as a recording, you can always ask questions in the comments. We respond back to those within 24 business hours. So a voluntary after-tax contribution is technically a type of employee contribution, but the limit is higher. That's how you're able to get up to potentially all the way up to the overall limit of 57 or 58 as an after-tax contribution, then move it over to your Roth sub-account, therefore, thereby making a mega backdoor Roth contribution, and really are able to make those Roth contributions to the much higher amount, as much as $58,000, for example, in 2021. Okay, so we'll start to dig a little deeper on these contribution limits and rules before we turn to the scenarios. But before we dig a little deeper, I'll knock out a couple of these questions. Thank you so much for taking the time to ask them. So the first question here is, to establish a solo 401k, is there a minimum income per year for a 1099 contractor? No, there is not. You just need to have legitimate earned self-employment income, and it needs to be consistent. It needs to be reported on your taxes as earned self-employment income, but there's no necessarily minimum amount. It should be consistent, though, not just a one-time event. So it's something that you would anticipate having year after year. Your next question, I have W-2 from a day job and 1099 from another employer. Does the salary deferral based on the W-2? No, it is not. So your ability to make contributions to the solo 401k is always limited to your earned self-employment income. That's what we mentioned back here on this slide. Don't consider W-2 wages from other sources, e.g. day job. So good question. So please continue to ask questions in the chat and we'll go through them. Meanwhile, we'll dig a little deeper in terms of how the contribution rules work. So employee contributions are what they also call salary deferrals. The limit is 100% of your self-employment compensation, up to $19,500 for 2020, plus an additional $6,500 if you're 50 or older. Now that limit stays the same for 2021. And this contribution can be made as a pre-tax contribution or as a Roth contribution. Keep in mind that you need to reduce it by any contributions made to another plan, like the day job 401k. However, if the other plan is a 457 governmental plan, those contributions are not aggregated. Roth contributions, as mentioned, the employee contribution, the $19,500 or the additional $6,500 to get you up to $26,000, if you're 50 or older, those contributions can be made as a pre-tax contribution or as a Roth contribution. So it's really subject to those same limits on the prior slide. A key point to always keep in mind is that if you're going to make Roth contributions, those need to go into a separate Roth 401k sub-account. For example, you might have a pre-tax sub-account, one account in the name of the plan for your benefit for your pre-tax money. Let's say you rolled over money from a former employer plan, but then let's say you want to make Roth contributions based on your self-employment income. Those Roth contributions would go into a separate Roth sub-account. So we would prepare the paperwork to open up multiple sub-accounts. Let's say you want to have your funds at Fidelity. We prepare paperwork to open one account at Fidelity in the name of the plan and under the EIN number of your plan for your pre-tax money, and then a second account at Fidelity in the name of the plan and under the EIN number of your plan for your Roth 401k funds. Now let's turn to the employer contributions. So employer contributions, another term for that is a profit sharing contribution. Here, the limit is 20% of your self-employment compensation. So you start with that pre-calculation to figure out what your self-employment compensation is, and that's how you calculate and determine how much you can contribute. For example, it's, for the employee, it's 100% dollar for dollar up to 19.5 or 26 if you're 50 or older. For employer, on the other hand, it's a percentage. So it's 20% of that self-employment compensation figure. So for example, if your self-employment compensation, after you take line 31 of Schedule C, less 1/2 of the self-employment tax, if that's $50,000, then you would be able to contribute 20% or $10,000 as an employer contribution. Employer contributions are always going to be deposited into the pre-tax sub-account because employer contributions are always done on a pre-tax basis. You can't make an employer contribution as a Roth contribution. Now, you also want to consider your overall limit. So you want to make sure that all the contributions that are being made to the plan, your employee contribution, your employer contribution, doesn't cause the contributions to exceed the overall limit, which is $57,000 for 2020. Or you could, if you made a catch-up contribution, then you would ignore the catch-up contribution for purposes of the $57,000 limit, and therefore you could get up to $63,500 if you're 50 or older. For 2021, that $57,000 overall limit is increased to $58,000. Now, keep in mind that contributions that are made to another plan on your behalf, like a 401k at a day job, those don't impact this limit. And you'll see when we go through scenarios that even though you might have contributions made to a plan at a day job, and that eliminates, let's say you maximize your employee contributions to your day job, and you therefore can't make any more employee contributions to the solo 401k, you could still make the employer contributions based on your self-employment income to the solo 401k. Now, an exception to that is the 403b exception. So you do have to aggregate and reduce how much you can contribute to the solo 401k by contributions made to the 403b plan. And thank you for those continued questions. We'll get through a few more slides and then we'll field some more questions. So the next slide here is talking about voluntary after-tax contributions. So here the limit is the lesser of your self-employment compensation. Again, you do that pre-calculation, line 31 of Schedule C less 1/2 of the self-employment tax. So you take the lesser of that number in the overall limit, $57,000 for 2020 or $58,000 for 2021, reduced by any employer or employee contributions made to the solo 401k. Keeping in mind that you ignore any catch-up contributions made to the solo 401k. So this limit doesn't go up if you're 50 or older. It's not impacted by contributions made to another retirement plan, unless the other plan is a 403b plan. And lastly, those voluntary after-tax contributions need to go into a separate sub-account. That's how you could end up with, say, 3 accounts of Fidelity. One account for your pre-tax money, a second account for your Roth money, and then a third account for your voluntary after-tax funds. And if you check out the Mega Backdoor Roth webinars, you'll see we go very deep in terms of how it works, et cetera, et cetera. Okay, so before we turn to the contribution scenarios, we'll field a couple more questions here. Thank you so much for taking the time to ask them. Please don't hesitate to continue to ask questions. So your next question is, can I then move the pre-tax employer 20% to the Roth IRA? Well, you've got to consider the distribution rules. If you want to move it to a Roth 401k, like inside the solo 401k, what they call an in-plan Roth conversion, you can do that at any time. If you want to move it out of the 401k to a Roth IRA, then you got to consider the distribution rules. Generally, if you're talking about pre-tax contributions, you're not going to be able to roll those out until you're 59 and a half. But keep in mind, if you decline to make the contribution as a pre-tax contribution and give up your ability to reduce your taxes for the year of that contribution, but instead made the contribution as an after-tax contribution, you could then roll over after-tax contributions out of the plan to a Roth IRA at any time. And again, if you look at the Mega Backdoor Roth webinars, we go into more detail about that. So when making a contribution to the pre-tax account, does one just write a check from their personal account to the 401k? So from a 401k perspective, and you'll see, and we go through how to make contributions in the later slides, you can make the contribution from either your personal account or your business account. Either is acceptable from a 401k perspective. Of course, your accountant may want, for accounting purposes, to have the employer contribution made from the business account and the employee contribution come from your personal account. Next question, what IRS form is required for reporting a solo 401k on taxes? So I'm not sure exactly what you mean, but if you're talking about contributions, then you would, and we're going to go through how to report it on your taxes in a later slide, but you'll see how it's reported on the 1040, for example. But there isn't an additional form that needs to be filed to report just the simple act of making a contribution to a 401k. Next question, what's the benefit of doing pre-tax versus after-tax contribution and then rolling over to the Roth? If the goal is to maximize the Roth, should I just do it all in voluntary after-tax? Good question. Of course, it's going to depend on the facts and circumstances, but that's a likely outcome, is just making it all as a voluntary and then moving it to the Roth. And if you check out the Mega Backdoor Roth webinar, which I'll include a link to those webinars, we did two, one for S corporations and one for sole proprietorships, like this, sole proprietorships, single member LLCs, 1099 contractors, the same audience or the same focus of this webinar, you'll see more detail about that. So let's turn to the contribution scenarios. So let's start with the base scenario and go over those assumptions. What we'll do to illustrate the points is we'll change some of these assumptions and see how it impacts how much can be contributed to the solo 401k. So the starting assumption is that we have a self-employed business that's taxed as a sole proprietorship, a single member LLC, or a 1099 miscellaneous or NEC Independent Contractor where the income is reported on Schedule C of the 1040. It's just one participant in the plan, under 50 years of age, does not make contributions to another 401k plan or another plan like a 401k at a day job. The goal is to first maximize the pre-tax contributions and reduce the taxable income, and then make any additional contributions as Roth or voluntary after-tax contributions. And then finally, $100,000 of self-employment compensation. So remember, again, that's that pre-calculation. Line 31 of Schedule C, less 1/2 of the self-employment tax. So with this scenario, the person is able to contribute $19,500, so that's 100% of their self-employment compensation up to $19,500 as an employee contribution, which because they want to first maximize the pre-tax, they would do that as a pre-tax contribution. They could do 20% of their self-employment compensation as an employer contribution, which is always going to be pre-tax. So now they would have $39,500 in their pre-tax sub-account. And then they could do the difference up to the overall limit. So that would be $17,500 or $18,500 for 2021 as a voluntary after-tax contribution. And then they can move that to their Roth solo 401k. Now let's change it from $100,000 of self-employment compensation to $50,000 of self-employment compensation. Same scenario, they can still do 100% up to $19,500 as a pre-tax employee. Now they got to do $10,000 because their self-employment compensation went down. They could do 20% of that, i.e. $10,000 as an employer pre-tax contribution, and then they could do the difference up to $50,000, right? Because it's the lesser of self-employment compensation or the overall limit. So it's the same for 20 and 21. The difference is still going to be $20,500 as an after-tax contribution, which they could then transfer over to their Roth solo 401k. Next change, we go back to $100,000 of self-employment compensation, but now let's assume that the person contributed $19,500 to a 401k plan at their day job. So here, they're not able to make any more employee contributions because they already maxed out to the day job. So it's $0. They want to maximize the pre-tax, so they can do 20% of their self-employment compensation, i.e. $20,000 as a pre-tax contribution, and they could do the difference as an after-tax contribution up to the overall limit. So that'd be $37,000 for 2020 or $38,000 for 2021, and then move it to the Roth solo 401k. Okay, now let's go back to the base, and now let's change it. So the goal here is to just maximize the Roth and or voluntary after tax, which I think would actually be responsive to one of the questions here. So in that case, they can do 100% of their self-employment compensation as an employee contribution up to $19,500. But instead of making it as a pre-tax contribution, they would make it as a Roth contribution because they're not interested in making pre-tax contributions. So then they would skip the employer contribution because that's always pre-tax, and they could do the difference as an after-tax contribution. So that'd be $37,500 for 2020 or $38,500 for 2021, and then move it from the after-tax account to the Roth account. So at the end of the day, they would have $57,000 in their Roth solo 401k for 2020 or $58,000 in their Roth solo 401k for 2021. Okay, let's go back to the base, and now we're going to change it so it's a two-participant scenario. So let's say it's a husband and wife or two business partners, two spouses. Then they're both working in the same self-employed business. They each have $100,000 of self-employment compensation. So really the key takeaway is that the limits are the same, but each person can make these contributions. So each person can make a $19,500 employee contribution as a pre-tax contribution, put another $20,000 in their pre-tax sub-account as an employer contribution, and then put the difference as a voluntary after-tax contribution. So that's $17,500 for 2020 or $18,500 for 2021, and then move those dollars over to their Roth solo 401k sub-account. Now let's go back to the base again with just one person, but now let's assume that this person is 50 years or older. So their ability to contribute as an employee contribution went up. Everything else stayed the same. So this person is now able to make an additional $6,500 catch-up contribution. So now they've got $26,000 in their pre-tax as an employee, $20,000 as an employer, and the difference as an after-tax contribution. So let's go back to the base. Now the person is back to being under 50 years of age. They contribute $19,500 to their day job plan, but here they want to maximize the Roth or voluntary after-tax contribution. So they already maximized and used up their employee bucket under their day job. They don't want to make any more they don't want to make any employer contributions because they're not interested in making pre-tax contributions. So this person would really make the entire contribution as an after-tax contribution. So that's $57,000 for 2020 or $58,000 for 2021. Because keep in mind that the after-tax limit is not impacted by contributions made to another plan unless it's a 403B plan. So then they can move the money from the after-tax bucket to the Roth bucket. So they'd have $57,000 or $58,000 for 2021 in their Roth solo 401k. Okay, let's go back to the base, and let's assume this person is 50 years or older, contributes $26,500 to their day job, so they maximize their employee contribution to their day job, and they want to maximize the Roth and or voluntary after-tax contributions to the solo 401k. So they cannot make any employee contributions because they already used up their bucket. They don't want to make any employer contributions because they're just focused on Roth or voluntary after tax. So again, this same person would put in 57 or 58,000 as an after tax. So one of the takeaways here is that even though they're 50 or older, they can't contribute. The limit doesn't go up. It's still 57 or 58 for 2021 as an after tax, and then move it from the after tax to the Roth. Okay, let's change it up again. So here we've got two participants. Each person contributes $19,500 to their day job plan. They want to maximize the Roth or after tax, and then each person has $100,000 of self-employment compensation. So as you can see, it's the same, but the key takeaway here is that it's the limit for each person. So each person now is able to contribute $57,000 for 2020 as an after tax, or $58,000 for 2021 as a voluntary after tax contribution, and then move it over to their Roth solo 401k. So before we turn to how to use our online calculator, we'll go through some more questions. Thank you so much for taking the time to ask the questions. Okay, next one I see here is, if one is thinking about investing in real estate with funds from self-directed 401k, is it better to use funds from pre-tax account or Roth account? So, I mean, ultimately that's an investment decision that you have to make. It's not always a one-size-fits-all solution. But obviously, if you are making the investment as a Roth investment, you have the potential for tax-free growth if you're able to later take out the Roth money as a qualified Roth distribution, meaning you've had the account for 5 years and you're at least 59 and a half. Next question, is there no required annual reporting to the IRS of how the funds are spent, distributed in a solo 401k? So if you're talking about investing, when you use the word spent, then specifically with regards to your question, no, there's no annual reporting that applies to investing solo 401k funds generally. If you're talking about distributing funds, yes. So if you're rolling money out of the solo 401k, or if you're taking a taxable distribution, then yes, it has to be reported on a Form 1099-R, which we handle that as part of our services for no additional charge. You just have to let us know so we can capture the information needed for the 1099-R reporting. Next question, can I contribute to the solo 401k in 2020 if I have not set up the account yet? I'm assuming that you mean, can you contribute to the solo 401k for 2020 if you have not set up the account yet? The answer is yes. So you would, the Secure Act extended the deadline to establish the plan until your business tax return deadline in 2021 for 2020. The conservative approach, though, is to only make employer contributions. Next question. As an S corporation with only one employee, what's the difference between an employer or employee contribution to a solo 401k? I hope this makes sense. I mean, it is really owned by the same person. So first of all, I would encourage you to check out last week's webinar, which is geared towards self-employed persons whose business is taxed as an S corp, as opposed to this webinar, which is geared towards people whose business is taxed as a single member LLC or an independent contractor or a sole proprietor. But as you could see in the scenarios, that there are significant differences. For example, employer contributions are always pre-tax. The limit is different. Employee contributions, the limit is different, and they could be made as a pre-tax contribution or a Roth contribution or even as an after-tax contribution. And so if they're made as a non-pre-tax contribution, those would go into different sub-accounts than the pre-tax contributions that you might make as an employer. You know, you also have to consider whether or not you're making employee contributions to another plan, because you might use up your employee contribution bucket. But you could still make employer contributions because that's not impacted by contributions made to another plan unless it's a 403B plan. So hopefully that helps. Now let's take a look at how to use our online calculator and more around the mechanics of making contributions. So we have a great calculator on our website. If you go to our website, mysolo401k.net, under the Learn menu, click on online tools. It'll take you right to the calculator. So for a self-employed business taxed as a sole proprietorship, single member LLC, 1099 miscellaneous independent contractor, where you're reporting your self-employment income on Schedule C, you would select unincorporated sole proprietorship. You would enter your net income from line 31 of Schedule C, so you don't have to reduce it by 1/2 of the self-employment tax. The calculator does it for you. You would enter the age of each participant as of the end of the applicable year. Then you would run the calculator. You can view the report to see the detail. You can print it to keep a copy for your records. Now, keep in mind that the calculator is not going to consider somebody who has making contributions to a day job plan. So you would need to modify it accordingly. The calculator is not telling you how much you can contribute as an after-tax contribution. So again, you would need to modify it accordingly. So let's turn to making contributions. So how do I make contributions? So of course you could write a check payable to the name of the plan and write annual contribution in the memo section. Electronic transfer is also acceptable from a 401k perspective. You need to check with the financial institution that holds the accounts to determine their process for incoming electronic transfers. Please note that most brokerage firms don't allow for incoming electronic deposits, with the exception being Fidelity. Each person is going to have a separate sub-account. So if you have two spouses that are both participating in the same solo 401k, and each making contributions to the same solo 401k, it would be one plan, but multiple sub-accounts. So one sub-account for one spouse, a second sub-account for another spouse. So for example, 2 brokerage accounts at Fidelity, one in the name of the plan for the benefit of one spouse, a second brokerage account at Fidelity in the name of the plan for the second spouse. And then if you have multiple types of money, let's say it's just one person, but that person has pre-tax, Roth, and after-tax money, that needs to go into separate accounts. So, you've got 3 brokerage accounts at Fidelity, one in the name of the plan for the pre-tax money, a second brokerage account for the Roth money, a third brokerage account for the voluntary after-tax money. To one of the questions, you can transfer the funds from personal or business accounts. That's acceptable from a 401k perspective. You could transfer the funds in one lump sum or a series of contributions. When is the deadline to make the contributions? So the deadline to make all types of contributions, so that's employee, employer, after-tax contributions across the board, is the business tax return deadline. So if you're reporting your self-employment income on Schedule C because you're a sole proprietorship, you're a single member LLC, you're a 1099 contractor, that means you're reporting it on your 1040. So effectively, your business tax return deadline is your 1040 deadline. So that's April 15th or October 15th if a timely extension is filed. And keep in mind that some CPAs may question this because they are applying the rules that apply to a full-time employer plan, i.e. a 401k plan that has non-owner employees participating in the plan. So the deadline to make employee contributions is different for those types of plans. But the fact that you have up until your business tax return deadline to make the contributions, assuming the plan was established by the end of the year for employee, to one of the other questions, is clear based on IRS publication 560. There's a chart on page 3 that just confirms that. So how do I report contributions? So it depends on what type of contribution that you're making. So if you're talking about employee pre-tax contributions, those are going to go on line 15 of Schedule 1 of the 1040. If you're talking about pre-tax employer contributions, it goes on the same line 15 of Schedule 1 of the 1040. Roth contributions, voluntary after-tax contributions are not reported. So that's NA. What about matching contributions? Can I also make matching contributions to the solo 401k? That's a common question and understandable, especially if you're coming from a corporate environment where you always had a match. So matching contributions do not apply to solo 401k plans. They apply to full-time employer plans. So plans that are for owner-only businesses, a one participant plan, a solo 401k, matching contributions do not apply. Solo 401k contributions consist of the contribution types that we went through: employee and employer contributions. So matching is when the employer matches what the employee has contributed. So the closest analogy would be the profit sharing contribution that may be made to the solo 401k. But note that unlike with a matching contribution where you have to, it presupposes that there's an employee contribution that is being matched, with a profit sharing contribution, which is the 20% of the self-employment compensation limit, as we saw in the scenario, in the scenarios, you don't have to have an employee contribution to make that employer contribution. In other words, if you max out to another plan, like through a day job, you can still make your employer contribution. So you don't have to, doesn't presuppose an employee contribution, unlike the match. So before we go to this next slide, we've got another question here. Thank you so much for the continued questions. So if a business employs one full-time employee, does that mean they cannot have the solo 401k? Correct. If you have a non-owner employee that's eligible, that meets the eligibility rules, meaning they're full-time, i.e. working 1,000 hours a year, or under the Secure Act, 500 hours a year for 3 consecutive years starting in 2021, that business cannot maintain a solo 401k. Another question. I want to maximize the contribution amount, $58,000 this year. I assume my salary is $58,000 this year. But what if $20,000 of my salary is coming from PPP loan? Then I can only contribute up to $38,000. Well, first of all, you have to do your you've got to do the pre-calculation. So you got to take your net. Let's go back to the slides that go over that. As far as the PPP, you got to work with your tax advisor to see how it's going to be reported. Remember, the starting point here is line 31 of Schedule C less 1/2 of the self-employment tax. That's how you figure out your self-employment compensation. So if you want to contribute $58,000, then it depends on what type of contribution that you're trying to make. If it's going to be all pre-tax contributions, then you're limited to the employee, $19,500 or $26,000 if you're 50 or older, assuming you don't make employee contributions to another plan. You can make that as a pre-tax. And then you could do 20% of your self-employment compensation as an employer. But that's not going to get you to $58,000. If your goal is to make it as an after-tax contribution, then it's different. So yes, because remember, with the after-tax limit, you can do dollar for dollar up to $58,000 for 2021. Now keep in mind, if you're looking at 2021 already, we're still early in 2021. So you want to make sure that you will have the self-employment compensation to justify that contribution. You don't end up in an excess contribution situation. So as far as the deadline, so if you did not set up the plan by December 31st of 2020, if you set it up by December 31st of 2020, you clearly preserve the right to make 2020 contributions all the way up until your tax return deadline in 2021. If you didn't set it up until after December 31st of 2020, if you set it up before your business tax return deadline, you could still make employer contributions. That's clear. The conservative approach would be to limit it to those types of contributions, because there's IRS guidance that would make it questionable whether you could still make employee contributions if you didn't set up the plan until after December 31st of 2020. So remember, the employer contribution limit is 20% of your self-employment compensation, and it's always made as a pre-tax contribution. Next question, can I make 100% of my salary deferral of my 1099 wages to solo 401k? Well, it depends on, so first of all, when you say 1099 wages, I'm presuming that you're talking about, let's assume you're talking about self-employment compensation reported on line 31 of Schedule C after you reduce it by 1/2 of the self-employment tax. So you can do 100% of that figure as a salary deferral, i.e. an employee contribution, up to $19,500 or $26,000 if you're 50 or older, assuming that you did not make any contributions to another 401k plan, like through a day job. So that's where this slide comes into play. 100% of your self-employment compensation up to $19,500 for 2020, or an additional $6,500 if you're 50 or older. Need to reduce by any contributions made to another employer plan. So that's the salary deferral limit. So let's go back to the calculator. I see the next question is asking for clarification on the calculator. So for that slide, went too far. So after-tax contributions are not addressed on the calculator. It's talking about employee as well as employer contributions. So your pre-tax or Roth, 19.5 or 26, you're 50 or older, and then the employer contributions, which are the pre-tax. So that's why we said we got to modify if it's after-tax contributions. Okay, so thank you so much. I think those are all the questions so far. So please continue to ask questions. Let's go to the next slide, which is clarifying what is not a contribution. So the following amounts are not contributions and therefore not subject to the contribution limits. So amounts that you rolled in from an existing retirement account, like a former employer plan or a non-Roth IRA, earnings from your solo 401k investment. So rents that you collect, let's say you have real estate that you own inside of your solo 401k and your 401k receives rent checks from the tenants that rent the property. That money that's coming back was an investment. I mean, it's really an earnings on your investment. So that doesn't count towards the contribution limit. Amounts converted within the solo 401k. So let's say you rolled over money from your former employer plan. We established up above that that's not going to count towards the contribution limit, amounts rolled over. And then let's say that goes into the pre-tax account. And then you move it from the pre-tax account to the Roth account. That amount that you convert doesn't count towards your contribution limit. You don't need self-employment income to justify being able to do that. Same thing with after-tax to Roth conversions. That doesn't count towards the limit in terms of how much you can contribute to the plan. You can do that on an unlimited basis. Lastly, repayment of solo 401k participant loans. So let's say you take a 401k loan. You can borrow under our plan up to 50% of the balance, not to exceed $50,000. You have to pay it back in monthly or quarterly payments, equal payments of principal and interest, which is generally prime plus 1%, or it could be prime plus 2%, or CD plus 2%. So it's either prime plus 1 or CD plus 2, with the payments spread out over a 5-year term. So making those payments doesn't count towards your contribution limits. So it's not reducing how much you can contribute to the plan. Okay, so we've come to the end of the presentation. Thank you so much for all the participation. Please don't hesitate to ask more questions. I will again post the links to the Mega Backdoor Roth webinars, as that will help. I think a lot of the questions here you'll find those webinars to be helpful. Please ask questions in the comments if you're watching this as a recording. Please again, like the video. Please subscribe for notifications of our weekly webinars as we do this every single week. And thank you again for everyone's time and participation. I don't see any more questions. So thank you again.